Good morning. Today I am going to talk about the different types of loans that people take, the common types of loans that people take. The first one, which is very common in today's generation, which is personal loans. Personal loans, they are taken almost by everyone who needs loans. So one of the pros are that they can be obtained for a few hundred or a few $1,000s. With repayment periods of 2 to 5 years. One of the major demerits which I have seen in personal loans is that they are expensive because the loan is unsecured. That is, the borrower does not put up any collateral that can be seized in case of default. Then the next type is credit card, which is almost very common amongst the employed people. Credit cards, every time a consumer pays with a credit card, he or she is taking a personal loan. If the balance is paid in full immediately, then no interest is charged. But if some debt remains unpaid, then the interest is charged every month until it is paid off. The next one is home equity loans. People who own homes can borrow against equity they have built up. In the difference between homes current face value and the amount still owed on mortgage, that is the amount which can be borrowed by the consumer. Pros is that the interest is charged in which is lower than the personal loan, and demerit is that the house is the collateral for loan. So if any case of default is done by the consumer, then the house is taken. The borrower will lose the house. Then next one is home equity loans. Home equity lines of credits works like a credit card but uses the home as collateral. One of the pros is that it can be used, repaid and reused for as long as the account stays open, that is 10 to 20 years. Interest is tax deductible, but unlike the home equity loan, interest is not set at the time of the loan is approved. As the borrower may be accessing the money, the interest rate is variable. The next type of loan is small business loans, sought by people setting up new business or expanding established businesses. Pros are that granting only after business owner has submitted a formal business plan for review. Business owners' personal assets serve as collateral against default on repayment. Interest rates are negotiable. These are the pros. Then the cons. Indispensable for most fledgling businesses. Creating a business plan and getting it approved can be arduous. The next one is gold loan, which is very common. Gold loan is almost people having a lump sum amount of gold can keep that as mortgage and take loan for that. Pros is that it is very flexible in nature because the interest rates are flexible, and as the interest rise or fall, the borrower has to pay that amount of interest. Then the next one is loans against the fixed deposits. Amount of loan that can be offered by fixed deposit between 70 to 80% of fixed deposit value. The interest rate varies. The next one is education loans. Covers the basic fees of the course along with allied expenses like accommodation, exam fees, etc. Pros are that the student has the option of not paying the EMIs until 12 months of the completing course or 6 months after he starts working, whichever is earlier. That's all about the types of loans.